Hi, you're watching Money 9. Well, very interesting times for investors as the Zomato IPO is creating waves. Stock markets are commanding new heights, and there's a plethora of existing as well as new mutual funds and ETFs coming to the fore almost every day. Should you, as an investor, rush into the IPO frenzy, or are you better off sticking to those traditional time tested mutual funds? We'll find out today with Deepak Shenoy. Hi, Deepak. Thank you for joining us on Money Masterclass. Well, Deepak Shenoy is going to spell out his strategy for retail investors and also list out the best mutual funds that you should invest in this year. You're watching Money Masterclass on Money 9. Deepak Shenoy, always a pleasure having you with us here on Money 9. Let me start by asking you the Zomato IPO. Why the frenzy around it? I mean, only 10% of the offer is actually open to retail investors. Allotment, as we know, is more of a game of luck. And Zomato, like many other technology startups, is loss making. What does it tell us about the investor?
Thanks, Karthik, firstly for having me on your show. From a perspective of what Zomato is versus a lot of other things, I think the problem right now is we have a lot of companies which we don't necessarily use in our daily lives. So if you look at the IT giants, we may work at them, but we don't use their products. If we look at a Reliance, I mean, sure, they produce gas and maybe you use a Reliance Geo, but that's a small portion of what they make eventually. A lot of companies, L&T for instance, and stuff like that, they make products, but they're not products we use directly. You do use some HLL or FMCG products, but a large amount of the newer set of products that we're using are all technology based. Whether that's technology like Android or Microsoft, Windows or Apple, or it is some of the new age startups like PayTM or Swiggy or Zomato. These are largely unlisted names for us, in the sense we don't get access to participate in their profits. A large amount of the interest now is that you're getting a consumer level startup where you have a business directly to consumer, a fairly large name, and a lot of institutional interest from outside India as well. That seems to be adding to the melee. I also feel it's one of the first in that space. So really, the first unicorn listing in India. That's also why you're getting a significant amount of interest. I mean, if you have 10 unicorns already listed, perhaps the race would not be as crazy as it is right now. But right now, there's so much interest about a loss-making company that's listing for the first time, 60,000, 50,000 crores. All of these questions come to the fray, but I think the interest is good. This is a fledgling business in its longer-term journey. And I hope they do well from a fundamental basis as well.
Right. So help us understand how does it work, Deepak? I mean, you usually invest in companies. Value investing is you buy it at the correct price, you hold on to it, you let it appreciate over a period of time. But the buzz around Zomato seems to be listing day gains. How do you see this play out in the long term?
Yeah, this listing day games game, is largely a loser's game because you'll win in some 10 and then you lose all your money in the 11th one. So it's really not something that I find very attractive, especially at the retail level. If you try stunts, you'll get like one lot. What are you going to do with that? If 16,000 rupees that you invest becomes 20,000, most people, it'll be like 10 Zomato orders effectively that you kind of invest. So it's not really something that's my game. I personally feel you most of the people are talking about want to invest really in much larger amounts of money or make larger amounts of money. This listing day concept is a waste of time. But you have to look at it as a space of how does this company look 5 to 10 years from now? They will be riders. They will still be riders. They don't employ people. They have people who work for them. This is quite remarkable because you have employment, but when you're employed, you're supposed to go to work every day, right? But as a Zomato rider, you can choose your working hours. So it's flexibility of being able to do so. Zomato doesn't buy the vehicle. The rider buys the vehicle and brings that to the table. And also, people work as much as they want, and their earnings are proportional to the amount they work, which is largely not the same in a job. In a job, you typically have people who work hard and make money, and then people who don't work and make money. So the employment, concept here is a little bit different. And they do that for a large number of riders, about 40,000 odd. And because of that, they've created a new segment, gig economy around the riding and the food delivery business. So much that a restaurant today will find it difficult to hire a rider to deliver their own food if they weren't on Zomato, for instance. So that part is one. They've created the concept of cloud kitchens along with Swiggy, where they've said you don't need real estate to great real estate, location, which is the mention of a restaurant business. A great restaurant should be like that. It's no longer valid. You can start a kitchen on the first floor of a house, and it would still could still be immensely popular and money making, cutting the real estate cost down substantially. So all of these factors are new. They're not the traditional restaurant business. So you shouldn't value them like a traditional restaurant business. They have created new opportunities where they weren't as many. Now, you could argue that the valuation is too much. I think, yes, it is extremely expensive. I think it's not for the faint-hearted. Amazon has been listed for, I think, 20 odd years now. And each of the first 3 years it listed, I think it went down at least 70% in some of those years. So we've seen this happen in giants like Amazon, where prices have fallen 70%. We should expect something like that will happen to Zomato also. In the course of its journey, it's going to see tremendous price drops, people calling that it's the end of the game for it and so on. The point about whether it lasts or not is largely about how much hunger management has in order to grow and how much the sector itself grows. So today they may have a few crore orders, and I'm thinking India will probably end up with a point where at least 15 to 20 crore people will be eventual consumers, and heavy users will order more. Some users will order maybe once a month, sometimes some once a week, some almost every day. So the remote order and food delivery business, I don't think is going away anytime soon. So the market is big. So this is where I think the investment thesis becomes interesting, because you're betting on both the sector doing well and the management being hungry enough and be trustworthy enough to be able to run this business and build it to a much larger scale. Only if you have that kind of a view, I think this is useful to invest in this business. Anything like listing gains, 3 months will make money, all that stuff is useless. And current losses notwithstanding, you can think of it as a loss. I'll give you perspective. They lose about 1,000 crores a year in cash flow, operating cash flow. After this IPO, they're going to have 15,000 crores in cash. They currently have about 6,000. They'll get 9,000 new crores from the IPO in cash. If they invested that money in something that give them 6 to 7% of interest, that interest alone will cover their operating losses for the last year. Of course, they'll probably lose more money in subsequent years because Amazon's coming, Swiggy's competition and so on. But I think we are underestimating the power of a business here, which has a lot of levers to grow. So I'm looking forward to see how this business goes going ahead. But you don't have to invest at the IPO. You can wait till it lists and then invest. You can wait 3 months and then invest. All the anchor investors are locked in only for 1 month. So after 1 month, if they change their mind, they will sell, they will bring the price down. You could invest at that time. There's no reason why you should jump in and only invest in these next 3 days and try to get this 16,000 rupee worth of investment.
Right, fair enough. So that's obviously, you've given a long-term fundamental view on Zomato as a brand, but series of other startups also queuing up for an IPO, and many of them likely to happen in this financial year alone, Deepak. So as a strategy, as a rule, should IPOs be given a miss by retail investors, wait for the price to settle down, stabilize, and then go in and view these businesses just like any other from a long-term perspective?
Yeah, I mean, so if you look at some of the recent IPOs where we've got some fairly phenomenal returns, I'll give you an example. Apple listed in 2019, it's more than 5x in terms of return since then. There was Root Mobile that's done more than, I think, 2x or 3x. There was CAMS, which listed about 3 years ago and is now more than 3 times what it demanded in the IPO. So a lot of such companies, including DMart. DMart was at 350 rupees when it listed. Now it's 10 times that. Little bit less than 10 times that. So there are some IPOs where I think long-term money has been made, even if you bought at the IPO. Even if you bought on the listing date after the IPO listed, the money has been made. But I say you don't have to invest in businesses at one shot. You can invest in them over a period of time rather than all at one shot. Why put all your money today? Put some money today, and then you can add more money if the business performance is to your liking, or take it out if the business sounds like it's going nowhere. Now we've seen a lot of IPOs do really well from the time they listed, but even if you put a significantly larger sum of money, 6 months after they listed, when you had price stability, you would have made more absolute amount. So I don't have to make 50%. If I make 50% on 20,000 rupees, I'll make 10,000 in profit. But if I make 20% on 1 lakh rupees, I will make 20,000 in profit, which is double what I made when I put the 20,000. So that's what I say. It's like it's largely about how much confidence you have, which allows you to put more money down on the table than to say, let's go in at the IPO, we're blind, sara paisa abhi laga do, and that kind of thing is not, my cup of tea. I think always invest over a period of time.
And especially so, I think in the context of people breaking other safer, secure investments to pile up that money and apply for the IPO. But just sticking to the fact that you said, the investor needs to be confident about the investment. How confident do you think is the investor today? And talking purely about the risk appetite, that there's almost a 10,000 crore rupee IPO of Zomato, and at the same time almost a 10,000 crore rupee NFO on the Flexi Cap Index. I mean, these are new risks that Indians seem to be taking. What does it tell us about the risk appetite of the youth in general, of the investor community in general today?
Yeah, so interesting point here, because we've gone to a point where FDs return next to nothing. So people want
to keep inflation in mind, then many of the new FDs that you would be parking your money in are actually depreciating your corpus.
Yes, and if you think about how some stocks are moving, some of these stocks are moving at 7%, 8% a day. So obviously people are excited. They're thinking that if I invest in the stock market, I may not lose money, but I will overall make money. We've seen this many times. 2000, 2008, 2007. We've seen this kind of euphoria build up, and I don't know where that euphoria is, whether it's the peak of the euphoria or the beginning of it. But I do know that there is a lot of.
It is definitely a euphoria, whether it is building up that momentum to the peak or at the peak already, but the euphoria is definitely there.
Yes, and more important than the euphoria is the fact that sometimes people will start to feel they're invincible. They will feel that I deserve this return because I have invested, and how can the market give me a negative return? It's not possible itself, so I'll even borrow money and invest. I will do a lot of interesting things to invest. The issue right now is that this overconfidence can be broken very easily. Market falls 10-15%. Some of these stocks will fall 25-30%. People inherently have a problem with losing even 1 rupee. When they lose 30%, they will be disheartened. We've seen this in the past, that they will go away and not come back. Some of them will not come back. The others may stay. Whether it is India, the US, any other country, there is a lot of euphoria, but India's retail market is even more spectacular. More than 40-45% of our trading happens to be retail. You take a significant portion of that away, the market will fall. In fact, if you look at the last 3 months, the market's been flat or rising on falling volumes. So even institutional volumes seem to be coming down in terms of overall volumes. So you're seeing the euphoria build up in a lot of places, and very extreme, the kind of expectations where you say I can minimum get 10% a month. This kind of thing will not last, and it can last another 2 months, it can last another 6 months, but at some point there will be these rising expectations. What I'm talking about as 10% per month, tomorrow somebody could become 20% a month, and one of these days that will not happen, and that will break people's hearts. I have no doubt that will happen. I just don't want to predict that will happen tomorrow, because that is a fun.
So what are you advising your clients right now? What seems to be the mood in your clients? Are you telling them to buy more equity or book profits and park a little more towards debt?
So we actually have this concept of saying maintain your personal equity and debt ratios to the same level. So if you started off saying I wanted to be a 75% equity, 25% debt person, and if the equity has gone way overboard, 75 has become 85 today because of whatever reason, the market's gone up and so on, then you can possibly sell a little and bring your debt equity ratio back down to a level which is more reasonable. Now, I don't say this as a panacea for everything, but I say it's a good way to kind of keep your profits and your exposure to the markets in a limited range. Now, a lot of people may be like, okay, let it go. Whenever it comes down, I will sell. They have to have the discipline to be able to do that. There are some people who do. So for those people, I say, well, do it your way. But when the market starts to fall, please take action. Don't hesitate and say, no, I am in this business for the long term. Being in the business for a long term does not mean you get to keep an 85% or 90% equity ratio when you have only 75% appetite. Most people who are getting in the market today probably have never seen any equity, or they have seen very little. They're mostly FD players. They're probably putting 5 to 10% of their money into equities today. There will be a time when many of these guys will put 50-60% of their money, and that could happen. That could already be happening. I just don't know yet. That is the time to worry, and those are the people where we would concentrate on and say, you don't have the appetite, please don't take that kind of risk. So I think it's different for different people that when we talk about how much they want to be in equity. But in general, we say this: you need equity exposure, no matter how high the market is. Don't go to zero and run away. This is not the kind of market that should make you, sit completely in cash. Have a certain amount of cash if you like, have a certain amount of debt if you like, but maintain a debt equity ratio corresponding to your risk, which means at least non-zero equity appetite.
Right. So let's cut to the chase. And if somebody were to look at creating or rebalancing a portfolio right now and follow either the 75-25 or the 70-30 sort of debt equity to debt ratio, what would you suggest? Which are the funds and which are the strategies that they should employ right now? Should they go in for a balanced advantage? Should they go in for a multi-cap? Should they go in for for the traditional blue chip stocks as well as blue chip mutual funds, and add a couple of debt products like fixed deposits? Just help us, asset allocate for somebody who's looking at the typical 70-30 sort of a ratio right now.
Yeah, so if you look at 70-30, the 30 can be in fixed deposits, it can be in debt funds, however you like it. Debt funds are a little more tax efficient because you don't have to pay taxes on the interest that is earned by the investments. But debt funds are a little volatile as well. When interest rates go up, they tend to underperform. But the debt side is pretty easy. People understand that very well. Fixed income, fixed deposits, that kind. On the equity side, I would say if you're a beginner, don't invest in these active mutual funds at all, because you won't understand which ones to invest. You'll go and choose the top 5 that have performed in the last 1 year. But if you have done that consistently over the last 10 years, you would have actually underperformed the index itself, because every year the top performers change. The ones that were performing last year, in 2 years from now, they will not be the best performing ones, simply because that's the way the market is. Some of the best mutual funds in the 2005-2007 era, after 15 years, have underperformed by nearly 4 percentage points than the index. So it may be better to just buy index funds. When I say index funds, I mean like a Nifty index fund,
right?
Relatively cheap, easy to get. And I would add, because we are using so many of these products listed in the US, you could buy a NASDAQ 100, US NASDAQ 100 fund, or a US S&P 500 fund. The idea that there are these index funds available in the market today. So you could do a balance between the India top 50 or top 100 as an index fund, and US NASDAQ 100 or the S&P 500 as a US exposure. And this can be your index exposure, whether you're doing it on a monthly basis or whether you're doing it as a one-time lump sum, is all fine. But I would definitely suggest that no matter how much money you have, if you're starting out today, spread the investment over the next 6 months rather than go all in today. So the way you should do that is, if you're starting to save, just use the index funds. These are largely large cap, so they will give exposure to the top stocks only. And you may feel you're missing out. So wherever you feel you're missing out, take a small amount of money of your own and go invest directly in those stocks you feel you're missing out. At least for the next year, it will give you a feeling of how good you are at picking stocks. And wait for a year, because it could be that in 2 months you double your money, and in the next 9 months you lose more than half of it. So you have to wait for a year before you get your own stock picking strategies right. But overall, I think focus on index funds for your core allocation. The satellite allocation, some small numbers which you can train yourself on, is more like an educative experience, and you can do that outside of this core allocation, and it can be a much smaller amount as well.
Right. And for somebody who's not a first-time investor but yet not a pro like you, what would you suggest if the person is a little more aggressively looking at equity exposure? Should small caps, mid caps be touched at all, or stay away from them? They're only for the big boys to play with.
No, I think you could buy a small cap fund. You could buy a small cap. There are many small cap funds. You could buy some of those. They have done really well. I think more than 100% in the last 1 year.
That's right.
This is a spectacular year. The 3 years before that were not worth writing about. So for the 4-year term time frame, small caps have still underperformed the large caps. But a small cap fund makes sense at certain times. Times like today may give you great returns over a very short period of time, but I feel that if there is a correction, small caps will fall 2x the amount that the large caps will fall. That means the large caps fall 25%, small caps will fall 50%. So you have to take that higher amount of risk. So if you're a seasoned investor, you could put 10% of your portfolio in small caps, maybe 15% in mid caps, and build that out. If you're a really pro investor who understands the markets, you could put most of your money in mid caps. It's perfectly fine. If you understand the businesses, there's nothing wrong in investing directly into mid caps or even a mid cap fund. And if you understand the risks of it. But most investors who are just starting out or have maybe 1 or 2 years of experience in the markets, they should build their mid cap and small cap exposure slowly, not immediately in a large way. So 10 to 25% is what I would suggest somebody build into their equity portfolios. So if you have 75 rupees in equity and 25 rupees in fixed income, out of that 75, you want to put 25% of it in mid and small caps.
Right. Well, unfortunately, that's all we have time for. Deepak Shenoy, always a pleasure having you with us here on Money9. Thank you so much for joining us.
Thanks so much, Karthik. Lovely to be here.
So, well, that's a wrap. A lot of insightful discussion there, and key takeaways coming out from that discussion that Deepak told us. Well, don't rush into the IPO. Let the price stabilize, let the price settle down. Look at the new listings almost at par with how you would look at value investing. And of course, if you're looking at balancing or rebalancing your debt equity ratio, if you're in the 75-25, 70-30 category for your equity exposure, go ahead and look at the index funds. And if you're a little more seasoned investor, then you could have a little bit of exposure to small caps and mid caps as well. Well, that's a wrap from all of us here on the Money9 team. Thank you so much. Do subscribe to our channel if you still haven't done that. And we'll get you more insights with more experts like Deepak Shenoy. Thank you so much. Bye-bye.